Bond yields are showing the Fed has won its battle against inflation. What do you think? Has the Fed succeeded at quelling inflation or not? This is Andrew Stotts of the Become a Better Investor community. Let's get started. Remember that this is for information purposes only. This is not investment advice or recommendation. I've put together a 120-page interest rate charts from all around the world in this, and you can download it by going to the link in the description below. I'm not going to present all 120 pages, trust me. So first, let's look at the two things we're going to discover. First is that unlike emerging markets, developed markets benefited from nearly free money. I start by GDP weighting interest rates across the world, and what I can come up with is that world interest rates for the short term, meaning 3-month rates, are currently at 5%. And what we're going to be doing is exploring the rise of interest rates and looking at it from a global perspective on bond yields and inflation. So short-term government rates in developed markets are 3.3%, and in emerging markets it's more than double that at 7.4%. Also, the developed markets have a GDP of about $52 trillion, in emerging markets about $36 trillion. So not yet 50-50, but I suspect it will be after maybe 5 or 10 more years. Now, emerging markets don't have reserve currency status. Unlike developed markets, they never benefited from zero rates. And you can see that here. I've got a chart of the 3-month government bond rates in the world, which is the red line, the developed market, which is below, and the emerging markets, which are above. So what we can see is over the past 12 months, the world average 3-month government bond rate rose from 1.7 to 5%. That's massive. This 3.3 percentage points rise highlights the rising interest rate environment that we've been living through. So in the developed markets, 3-month rates rose from 0 12 months ago, before the Ukraine war started, to the current 3.3%. Now, despite this strong rise, developed market interest rates remain at a 1.7 percentage point discount to the world average, meaning emerging markets are above and rising equally fast. So let's look at emerging markets for a moment. Over the past year, 3-month rates rose from an already high 4.3%, that was a starting point, to 7.4%, up 3.1 percentage points. That's double the rate of developed markets, and that's a 2.4 percentage point premium to the world average. The point is that short-term rates in emerging markets were already high, and they've gone higher. So now let's look at long-term rates. In this case, we're going to look at 10-year government bond rates, because the objective of the Fed and any central bank is they're playing around with short-term rates and hope that it will impact long-term rates. So let's look at 10-year government bond rates in the developed markets, and they're yielding 2.9%, and in emerging markets, they're yielding 5.6%. So what does this mean? Well, this means that in developed markets, yields are inverted from normal, with long-term rates of 2.9, which is 0.4 percentage points below the short-term rates of 3.3. It's normally the reverse. And emerging markets are inverted too, with long-term rates at 5.6, which is 1.8 percentage points below the 7.4 short-term rate. So we can see even heavier inversion in emerging markets. So the developed market 10-year yield started to fall in January. That's an interesting point, because that tells us that the participants in the market have seen the Fed's rise in the short-term rates and are saying, I'm okay, I think that means inflation is going to be under control, and therefore I don't need such a high return on my long-term government bonds to compensate for super high inflation. So let's look at world long-term rates for a moment. World long-term rates rose from 2.8% 12 months ago to 4% today. That's a 1.2 percentage point rise. Again, we're talking about long-term bonds. Now, developed markets saw a year-on-year interest rate rise from 1.2%, which is pretty low for a 10-year bond, to 2.9%, up 1.7 percentage points. Developed markets' discount to the world interest rates rose from negative 1.6 percentage points to negative 1.1 percentage points, so it narrowed that gap. And emerging markets had a small year-on-year 5.5 basis points or percentage points rise from 5.1 to an already high 5.7 5.6. So sorry, it went from 5.1 to 5.6. But my point is, the line is flat. There's been very little movement. The emerging markets premium to the world fell from 2.4 percentage points when all the developed markets were super low, now to just 1.6 percentage points 12 months ago. In other words, the developed markets deep discount is gone, and we're getting interest rates converging to some extent. So what are the key points in the bottom line of this section? First, emerging markets never had reserve currency status, unlike, let's say, US and Euro. So unlike the developed markets, they never benefited from zero rates. Now, since rates have always been higher in emerging markets, borrowers there have not had the same incentive to borrow as in the developed markets. Therefore, the balance sheet quality is pretty good, and emerging markets are in pretty good shape. Unlike emerging markets, developed markets ultimately benefited from nearly free money. Remember, go to the link in the description below to download this 120-page slide deck of charts. Well, we're not going to cover 120 pages now. We're going to go into the last section that I want to look at. And this section shows us that the market believes that U.S. short-term rate rise has quelled inflation. Do you? So let's look at that in more detail. Short-term government rates are 4.7% in developed markets America. Remember, this is 3-month rates. And they're 1.1% in developed markets Pacific and 2.5% in the developed markets Europe. So let's look at that in more detail. U.S. has led the rise, of course, with the Fed aggressively moving short-term rates. And developed markets, developed Europe is catching up. And developed markets Pacific is at a deep discount to the world. So this chart shows that trend over the past 12 months. And thanks to the Fed, the developed market Americas rose from 0.2 to 4.7. That's up a massive 4.5 percentage points. Now, for those people who are concerned about a rising interest rate slowing down the economy, this is good evidence that it could potentially do that, as you see in developed market Americas. Now, in the 120 pages that I have put into the link below, you'll be able to see the U.S. and the other countries that are the prime components of this. But for right now, we'll look at the regions. So the developed market Americas, which is mainly U.S. and then Canada, its relative discount to the world narrowed from negative 1.5 percentage points to negative 0.3 percentage points, meaning it's just about in line. Developed market Europe rose from negative 0.4% to 2.5%. That's a significant rise from 2.9 percentage points. And the key here is that Europe was zero for government bonds. Now, its relative discount to the world widened from negative 2.1 percentage points to 2.5. So developed market Pacific is interesting. We're really talking about Japan mainly. Of course, there are other developed markets like Australia and also Singapore. But it rose from 0 to 1.1, which is very small. Its relative discount to the world widened from a negative 1.7 percentage points to negative 3.9. So that's part of the reason why there's a lot of pressure on the Japanese currency, because that's a major component on it. So now let's look at these long-term rates in a little bit more. So we finished up with short-term rates. Now we're going to look at long-term rates. And what we can see is that developed market Europe, long-term aggressive rise from near zero has prevented a euro currency collapse. So this short-term rise in the developed market Europe, as well as long-term rise that we see, is trying to be done in a way that it can protect the euro. We saw that the UK was in a difficult situation because they have the British pound, and the British pound was kind of attacked, so they have to keep the interest rates particularly high there. So developed market Americas rose from 1.8 to 3.4. That's up 1.7 percentage points for its 10-year government bond rate. And the relative discount to the world narrowed from a negative 1 percentage point down to a negative 0.6. Long-term rates fell slightly in January. This is the interesting part. The market believes inflation is starting to turn. What do you think? Well, let's look at developed market Europe. Here we can see that they rose for 10-year bonds, rose from 0.6 to 2.8. That's up 2.2 percentage points. The relative discount to the world narrowed from negative 2.1 percentage points to negative 1.2. And then developed market Pacific rose from 0.7% to 1.4. That's up 0.7 percentage points. And it's still, I mean, look at how low that is, 1.4% for a 10-year Japanese mainly, but let's say developed market Pacific bond. So government bond. Now the relative discount to the world widened from negative 2 percentage points to negative 2.6. So what are the key points that I want you to take away from this? First, the US led the rise in interest rates. Developed market Europe is catching up, and developed market Pacific is now at a deep discount to world rates. Number two, developed market Europe's long-term aggressive rise from near zero prevented a euro currency collapse. And importantly, long-term rates fell slightly in January, showing the market believes inflation has been tamed. The bottom line, the market believes U.S. short-term rate rise has quelled inflation. Remember, you can go to the link in the description below to download the slide deck. It's 120 pages of interest rate charts. So let me end by asking you, what do you think? Has the Fed succeeded at quelling inflation or not? I'll look for your comments in the comment section.